Good morning. Welcome to Stock Market Today. It's Tuesday, November 10th, 2020, and this is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities were higher on Monday, though indices closed well off the best levels of the morning after positive vaccine news sparked big opening gaps. Energy and financials were the best performing sectors on the day. Discretionary tech and staples underperformed. Treasuries sold off, and the curve steepened in a big way. Dollar was stronger on the major crosses. Gold finished down 5%. While crude oil closed higher by 8.5%. And as we get to the desk this morning, S&P futures are down about 0.5% after Asian equities were mostly higher overnight. European markets are mostly higher as well. Treasuries are unchanged to slightly firmer. The dollar is better on the euro, a little changed against the yen. Gold is up 1% after yesterday's big sell-off, and WTI crude is up 90 basis points after that big rally on the day yesterday. So a lot of moving parts. Obviously, the vaccine news was the big driver, and that driver was a dash for trash, if you will. Taking a look at the markets here, I asked the question, how thick is your line? Because we'll call it a breakout. We had a gap and then a complete fade throughout the rest of the day for the S&P 500. But, we kind of did break out briefly, and we're holding above. Now, what we don't love, I don't love seeing the futures down 50 basis points here this morning after the fade yesterday. I would hate to see this be a false breakout, right? But our roadmap largely has played out. New highs were reached. We said if we broke through 340, we were going to go through the highs, and that's exactly what happened. So now support becomes 340, or 340 becomes support, and then below that, 320. 260 key support continues to be the place for Qs, which did not break out yesterday. Repeat, did not break out yesterday. Didn't even gap on the open, and then faded throughout the day to actually close down by about 2%. IWM finally breaks out, finally breaks above those levels from earlier this year, just like we said was likely to happen with the trends higher. Support now near 160. So what's happening here is a massive shift under the surface of the market, and whether it sticks or not remains to be seen, but it's happening now, so we want to monitor it. The growth trade is coming off. We'll look at tech relative in a little while. We'll look at financials relative. We'll look at the defensive groups, but the growth trade appears to be coming off, right? The economy is getting better. Now we have a vaccine that looks efficacious. That's a headwind for the growth trade. Throw in the fact that the curve is steepening and yields are moving higher. You have a second headwind for the growth trade. So these are things you have to monitor. If you're long a lot of the COVID winners, you may be taking some stops. If you're trading, and if you're thinking of these as longer term investments, just be mindful of the fact that you're now dealing with some headwinds in the form of a better economy that has the potential to continue to get better now that we have a vaccine. Let's get to what we're talking about in the note today, our market in a minute. Morning gaps give way to afternoon selling as the vaccine news dropped. That news hit before the open, massive gaps higher. I mean, the small caps were up. I think they were halted yesterday morning in futures trading up 7%. Qs remain in the range as the growth theme gets sold. Financials, are they bottoming? We're watching the yield curve closely, but there are early signs of a bottom in the financials. Japan trades at a 29-year high. We looked at that chart yesterday. We're not going to look at it today, but I'm highlighting it in my note. And as I said, futures point to a lower open here today. S&P futures down about 50 basis points. Our major indices from a power bar perspective, the Dow strengthened. Dow up 3% yesterday. Was much higher. Was up over 5% at one point. 3-2 bulls to bears there. S&P 500 adds 1.25, 129.57 bulls to bears. NASDAQ, there's your move down. Down 2%, 16.13 bulls to bears as the big COVID winners, the Grow, Momo, the Pelotons, the Zooms of the world, were absolutely smashed yesterday. So, I know me personally, I was long Peloton and, had to take my stop yesterday. Thankfully did not own Zoom. Small caps, big outperformers, up 3.7%, 766 to 220 bulls to bears there. Bonds down ticked hard. Bonds hit hard. I think that's partially inflation pressures. I think that's partially improving growth prospects, and those two kind of go hand in hand. But bonds down hard, sending yields higher. 10-year over 90 basis points. And energy, arguably the most hated sector of the market, up 14% yesterday, 3 to 9 bulls to bears there. According to the Chaikin Power Bar, small cap stocks, large cap stocks are bullish. Major indexes are mixed. Let's hit our stocks of the day now. So if the rotation is in fact playing out, I think we need to make sense. I think it makes sense to begin looking at the names there that could provide potential opportunities. We've highlighted materials and industrials in the past as our favorite cyclical sectors, right? We started warming to materials back in June and in the industrials back in August. So we've been watching this rotation begin to play out for a few months. Today, I'm adding in energy and financials, not so much because I think that they're great trades, but I just want to have those two groups represented here. Energy is still very bearish in our model. But so I use those four groups as our cyclical sectors, and I screen for names that are very bullish and bullish. Now, you'll see 3 neutral names there. That's because the screener, the model updates before the screener does. So those are, these stocks were all bullish or very bullish yesterday. And I wanted the ones that have relative strength, right? Because it's great. Yeah, we know the cyclical areas are improving, but I don't want the names and continuing to lag the market. So a quick screen of those 4 sectors for strong relative strength with bullish or very bullish ratings, uncovered 26 names. Now, obviously, that's just the S&P 500. We could broaden this out if we wanted to, but the cyclical sectors, bullish names outperforming. Pretty simple, right? I'm not saying that they're oversold and that they're set up right now, but I am saying that these are probably names we want to be paying attention to, right? Names like Capital One, Discover, Synchrony, right? You've seen a lot of banks in there. General Electric, right? Former darling, right? I mean, business schools studied General Electric in case studies, and then it completely fell out of bed and has been an utter disaster. Maybe it's making the turn. I don't know. But I certainly want to pay attention to it if it is. RF, WestRock, some names on here that we've talked about in the past too. FedEx, Freeport McMoran, Silicon Valley Bank, SIVB are all names that I've highlighted in my notes. CMI. So Chaikin clients have been on top of some of these names for a while. But I think it's a good screen. Take a screenshot, save it. I think it's some names to have on a watch list here and to continue to do work on. Let's look at our sector tracker now. Movement of the major sectors over the last 5 days. Energy financials moved to the top of the list with their monster moves yesterday. I mean, the moves in energy and financials yesterday were a sight to behold, right? Just kind of goes to show you how hated those groups have been, how under-owned they are, that as soon as the vaccine news dropped, they ripped to the upside. Tech falls to the number 3 spot. And, like I said, it's under pressure. I mean, the Qs are, NASDAQ futures are trading lower this morning. Industrials round out the top 4. Healthcare, comms, materials, middle of the road. Discretionary, REITs, staples, utilities, bottom of the list. Discretionaries come under some pressure here in the near term as well, on both an absolute and a relative basis. Number 1, Amazon, massive weight in the group. And some of the high-flying retailers and home builders have been sold. All right. There's been some profit taking as we've seen a rotation away from some of the growth and momentum names in the market. So we want to be mindful of that. Take a look at a chart of ITB, the construction ETF, the home construction ETF, on the verge of a breakdown. Our industry in focus today, mining services, past 6 months, been a great trade. It's been an area of the market that we've liked. S&P 500 outperforming it by 14.75%. Power bar ratio 10-0, bulls to bears. That's very strong. Currently ranked number 2 of 21 subsectors, and it's moved down 1 slot over the past week. So we want to pay attention to names like Alcoa, Reliance Steel, and United Steel, AARS and letter X, respectively. First 2 with very bullish ratings, United with a bullish rating. Take a look at the ETF. The ETF has a bullish rating, strong trend above a rising long-term trend line. And we get a topside breakout from a consolidation pattern, and we actually held above the breakout level. Been outperforming since mid-July. Money flow mixed of late, but still slightly bullish. Only real knock I have here is that the fund is overbought. But I think if you buy into a growth, returning to the market, returning to the economy type trade, rather, you should probably be paying attention to the metals and mining space, and we certainly are. Take a look at XME and its holdings. There are 10 bullish stocks there that might make some sense. Let's look at what's trending now. Honestly, don't have anything insightful to say here. The winner side of the board, all purely from the vaccine, right? REITs and Carnival Cruise Line. So what else is there to say? vaccine, things are going to reopen. People are going to take cruises again, right? May go shopping in bigger, bigger groups. More people might be hitting the malls. Not a ton to add here, but you can see the rip. These things were all up over 30%. I don't have any value add other than that, so I'm not going to try to force it. Loser side of the board, much the same with the bottom four. Etsy, Pool, Clorox, and Whirlpool were all big winners to the lockdown. They were the bulls to the COVID trade. Etsy, obviously a high flyer, comes off 17%. Pool, Clorox, right? If there's a vaccine, maybe you're buying less wipes and bleach. I don't know. And Whirlpool, part of that trend along with the home builders. Biogen is the one that actually had something company specific. Now the stock was halted all day on Friday as they were going in front of the AdCom, and the results that they got from their AdCom on their Alzheimer drug were not encouraging. And the stock, after rallying 44% on the initial news one day last week, down 28% upon reopen yesterday. So, and that's what I have there as far as the movers and shakers go. I wish I had more for you, but I don't, so I'm not going to force it. Might as well talk about where we can add some value, right? Look at this tech trade, XLK relative to SPY. Last week, we pointed out how it was breaking down out of the consolidation. Now, what's interesting is, on the heels of the election and some positioning away, squaring up positions after the big blue wave bets, we had an initial rally in tech, which gave way. That rally took it back to the apex of the triangle, and then we faded. So we're still below the 50-day moving average, above the 200-day, right? So from a longer-term trend perspective, the trend is still to the upside, right? RSI, series of lower highs, but not becoming overbought or oversold. So let's call it a bullish trend that's under pressure. XLK on an absolute basis continues to hold above the key 110 level, but we need to be mindful of this, right? I mean, this has been an easy trade for a long time. It's been the big winner. It's been an easy trade. And I just think that the tech trade, the growth trade in general, is no longer the easy trade. It was an easy trade for 2 years, just kind of own growth, right? Global growth was slowing. You saw it showing up in the data. Growth stocks were outperforming, and it was just an easy trade. And now it's not, and that's fine. You're gonna have to be more selective in the group, and you're gonna have to broaden your horizons, I think, and look at other areas of the market that might be compelling. I mean, I'd be remiss if I said I wasn't paying attention to what's going on in the financials right now, right? And I've been talking about materials and industrials for months. So, the rotations play out. It's not flip the switch on off. Go growth, go value, right? You'll see subtle transitions in the market, and that's what's playing out, I think. This is certainly not broken, but it's bending, and we want to be mindful of that, especially just kind of given how loved a lot of these stocks are. So we just want to pay attention to it. Certainly not calling a top, but mindful of a potential phase change. And then going the other way, right? Here's financials. Take a look at the financials on a relative basis here. Now, we used this chart last week, and we said they were improving. We noted the bullish divergence on the RSI, and then all of a sudden, look what happened on Monday. Nice topside move. Similar story in reverse to the tech trade. Still under pressure, from a longer term perspective. Cast to contend with 200-day, but watch that yield curve at the bottom. That yield curve steepening is going to be a tailwind for the banks, which has the potential to drive the financials further to the upside, right? So, I think your takeaway when you see a chart like this is, let me do some work on the group. Let me see if there's compelling names in there, right? That screener that I just showed you had a bunch of banks and financials on it. So I think, that's kind of that's how I'm looking at it. I'm saying to myself, there's something potentially changing here. Let's see if we can identify potential opportunities. And then I take a look at something like the yield curve, the 210 spread at the bottom of the chart, breaking top side. And I say to myself, there's potentially a tailwind here as well. So interesting dynamic playing out for a group that's been beaten down for a long time. And then finally, from a market's perspective, hard to get overly concerned when the defensive groups on a relative basis look like this. So I think the market is still fine. That's going to wrap us up for today. Take us for a test drive. I'll be back tomorrow.